All right, guys. So today we're going to delve into probably what is one of the most important topics for you to understand to be successful financially as an independent adult. And that is understanding credit and how to manage your credit effectively. Now, at the end of the day, when we're talking about credit, credit is just simply the economic term for any kind of loan that you're ever going to take out. So, of course, if you go and you buy a car and you take out a car loan, that is a major form of credit. Probably the single biggest line of credit that most Americans will ever take out is a mortgage. And basically, what a mortgage is you go to the bank and you take out a massive loan, oftentimes for 15 to 30 years in length, in order to pay off the value of your house. Sometimes people will get out a personal loan from a bank. Sometimes you'll hear about people talking about something like a home equity line of credit, where they basically are using the value of their home as a way of securing a large sum of money loan from a bank. If you're somebody starting up a business, there's all sorts of small business loans available. And then, of course, probably the type of credit that most Americans utilize most often is, of course, a credit card. And I always say that, as a young adult, one thing that you really need to understand is the difference between a credit card and a debit card. Because even though they look very similar and you put them in the same kind of machine, they're actually very, very different. Basically, as this illustration shows, a debit card is a card that's directly tied to your bank account. So you swipe that card, you put that number in, and that money is coming right out of your account. Some people really like debit cards and use them on a regular basis because it helps them stay within their means and not overspend and not use money that they don't have and kind of budget effectively. But there's also some potential drawbacks of debit cards. A debit card, for example, should never be used to make an online purchase. Because let's say that you're somebody and you're ordering something off of a website and it gets messed up and they overcharge you, or instead of ordering one, your key's stuck and you accidentally order 10. Well, while you might be able to rectify that problem over time, at the same time, that money is now no longer in your bank account. And so maybe you don't have the money to make a food purchase or pay your bills until you fully get your refund. The other thing is, let's say somebody steals your credit card information and racks up $2,000 worth of charges. Again, you might be able to eventually get that money back, but in the meantime, there's going to be some potential financial hardship. With a credit card, when you put your credit card in somewhere, basically what's happening is that the credit card company, so Visa or MasterCard or whatever, is basically paying the money to the seller. And then they are sending you a bill for, in essence, that money that they have loaned you. So, hey, I go online, I buy $50 worth of shirts. Well, it's actually Visa that has spent the $50. They have loaned it to me. And now they're saying, hey, you got to pay that $50 back. So again, it protects you, because if something does go awry, you simply call up the credit card company and you say, hey, I didn't make that purchase. You need to investigate. And again, it's no money that's directly coming out of your account. And companies like Visa or MasterCard have a ton of people on their payroll that are meant to investigate credit card fraud. So that's a lot of resources that you personally don't have at your disposal. Things like hotels generally will want a credit card that they can bill in case of damage. Things like renting a car, they're almost always going to want a credit card as well. So there's definitely some benefits to having a credit card as you establish yourself as an independent adult, and it gives you a lot of flexibility too. We all have those things that sometimes pop up in our lives, especially as you have kids, where sometimes a credit card is going to give you that needed financial flexibility. Now, probably the most important thing to understand about credit is that regardless of the type of credit you are utilizing, all of these forms of credit are connected via something called your credit score. And your credit score is specifically connected to your social security number. So it's something that is constantly changing your entire adult life. There's no way of kind of dodging out on it financially because, again, everything is tied to that number that is attached to you. Generally speaking, your credit score is a numeric value between 300 and 850, with the higher the number, the better it is. So a perfect credit score is in essence 850. That number basically is a number that represents how trustworthy you are with money. So if somebody loans you some money, how likely are you to pay it back in full on time with no problems whatsoever? Generally speaking, there are three different credit agencies out there, and I've listed them on this slide, that monitor your credit score 24/7. And those are TransUnion, Equifax, and Experian. And you are guaranteed by law the ability to check your credit score for free from each agency once per year. So, of course, if you check it more than that, they're permitted to bill you. And there's all sorts of credit reporting services out there, or websites that you can pay a fee and check it again. But I put here a link to a site, www.annualcreditreport.com, where you would be able to access that free credit report once a year. I put up here also a graphic that just kind of shows a breakdown of credit scores ranges. So basically, out of all Americans, about 21% are in this what they call exceptional range, and they're 25% in the 740 to 799 very good range. And especially if you can manage to get yourself somewhere in this range, that is going to result in you being able to generally acquire loans, be loaned larger amounts of money, and also, and probably most importantly for many people, get much lower interest rates. Because let's say that you're somebody that is taking out a $100,000 mortgage to buy a new house, and let's say that you can manage to get a 2.5% loan, whereas maybe somebody else who's buying the same house can only get a 4.5% loan. I mean, that little difference of 2% multiplied over a large amount of money over the course of 360 payments or 30 years can be a difference of tens of thousands, if not hundreds of thousands of dollars in simply interest payments. So knowing your credit score, at least being somewhat aware of it, and making sure that you keep it as high as possible is something that will benefit you in many ways. I also even put down here at the bottom that in addition to just taking out loans, you get a car insurance. All of us are required by law to have car insurance in Pennsylvania. Well, your credit score can impact your car insurance premiums because, again, it shows kind of your riskiness and it shows your likeliness to pay on time. Many landlords will oftentimes also ask to run your credit before you are granted the ability to rent a property. So if you're somebody that's looking to rent a house or looking to rent an apartment, if they pull up your credit score and you have a low credit score, they might say, listen, we're not going to loan to you because we're afraid that you're not going to pay up on time. So very important to monitor and to keep that as solid as humanly possible. Now that brings up the question then, okay, well, what are some things that generally will impact my credit score? So like, what's the stuff that I should be aware of kind of day in and day out? So I put here a basic breakdown of what numerically determines your credit score. So 35% of your credit score basically comes from payment history. And specifically what these credit reporting agencies are looking at is that they are looking at the number of late bills that you have ever had, or at least over, a few year duration. They want to also see that, with those late bills, like, how much did you owe? Like how much balance do you have maybe on your credit cards, or maybe how much unpaid money do you have to the gas company or whatever? And then they also monitor the number of days late on these bills. So if you're somebody that, had one late bill once over the course of 5 years, and it was, $120 for, your cable bill, and it was 2 days late, that's probably not going to have a major ding on your credit score. Now, let's say that you're somebody that, has 5 different credit cards and they each have a really large balance on them, and you've paid 2 of them off late multiple times a year, and you also were late paying your electric bill for a few months, and you were also late on paying your gas bill, and you currently have a backlog of like $300 on unpaid bills with additional fees and interest. That's the kind of thing that's going to really start to erode away on that credit score in a hurry. So always pay your bills on time. Always try to pay them in full when you get them. And that's all bills. Second big category here, what they call the debt to income ratio. So how much credit do you have already amassed? So like total value of all your loans. How much credit can you potentially exercise, and how does that then compare to your overall yearly income? So I put just this kind of sub note that usually the credit reporting agencies and banks want to see that your debt to income ratio is fairly low, and they definitely want to see that it's under 50%. So if you're somebody that, maybe makes $50,000 a year, but you have, 5 credit cards, each with, an available credit line of $5,000. Well, your available credit is $25,000. Well, that's 50%. And then let's say on top of that, you have a car loan for $9,000 and you have a personal loan for $10,000. All of a sudden, your amount of debt or potential debt is very high compared to your ability to pay it off. So you want to keep that as low as you can. Length of credit history, 15% of your overall credit score. So what this means is that they want to see that you have a long history of paying on time, so that you've had certain accounts that are open for a while. So generally what you don't want to do is you don't want to be opening and closing like credit cards constantly. It's good to have maybe a credit card that you opened up a long time ago that maybe you don't utilize anymore, but it's still an open account, and you just kind of keep it in your wallet there to establish that you have this long credit history. So you don't want to be opening and closing credit all the time. You see the same thing there in there, 10% frequency of new credit. So if you're opening new lines of credit all the time, that is a red flag. This can also be something as basic as doing lots and lots of credit checks. So like, let's say that you're somebody who's shopping around for a new car. And let's say that you go to, 8 different banks and get pre-approved for a car loan. Well, before they do that, they're all going to run your credit score. And then let's say that you go to a bunch of different car dealerships and you allow them all to run your credit score. Well, you might run your credit score, 10, 15 times before you actually take out a loan. All of that has the potential to show up on your credit report. So just always be aware of how many times you're running those kind of reports. And then finally, types of credit used. So not all credit is kind of viewed equally by the banks. Things like, maybe a student loan is viewed as much preferable to something like a bunch of credit card debt. So again, not all credit 100% equal. Now, a question that a lot of times students ask me then is, okay, well, where do I start? Like, here I am, 18-year-old, 19-year-old, starting out on my own, young adult. What's a good starting point to establish solid credit? Well, one of the most basic things that you can do is just maintain a stable income. Try to have the same amount of money coming into your bank accounts each month, budget appropriately. Don't overspend your money. That goes a long, long way. Again, start establishing certain bills. So maybe, you got your cell phone bill. Maybe you got your car insurance bill. Maybe you got a car loan already. Be paying those always on time. Again, that's a big part of your credit history. And then what I always recommend to people is, if you don't have a credit card, somewhere along the line, it will benefit you to open one. I recommend opening one that has a fairly low credit limit. So you can usually establish this through a bank if you get one through a bank, or different credit card companies. And maybe you say, hey, I want to open this credit card, but I want my credit limit to be $200 or $300, something low that you're not going to get yourself in trouble with. and then use it for maybe expected expenses. So maybe you use it only for filling up with gas. And maybe you know that, hey, I fill up with gas maybe once a week and I spend $40 a week on it. And just each time you do that, put it on your credit card, knowing then that, hey, you got to pay that off by the end of the month. Some other things to be aware of also, and this kind of goes along with what I was saying with that maybe lower limit credit card. Jumping down a little bit here. If you pay off your entire credit card balance at the end of that first month, you don't pay any interest. So let's say that you've opened up a credit card with a $300 limit and you've only used it, for filling up with gas. And by the end of the month, you owe $240. If you pay off that $240, you're paying not 1 cent in interest for that whatsoever, while at the same time building positive credit. So again, something that I always recommend people keep that balance paid off whenever humanly possible. Some other things to be aware of: any credit card when you sign up for will have somewhere on the website or the agreement that you're signing off APR. APR stands for annual percentage rate. So that's the interest rate that you are paying on that loan or those loans that you're taking out over the course of the year. Now, with a lot of credit cards, what they'll do to try to entice you to sign up is that they will have maybe a different APR for the first maybe 12 months, and then that APR will change. So let's say that you're somebody that takes out, a credit card that has 0% APR for the first 12 months. Well, whatever you rack up there, it's an interest-free loan for a year, but then you hit that 13 month and all of a sudden that 0% APR might jump to 15% or 20%. So they're hoping that you're going to rack up this big balance, and then they're going to hit you with a high interest rate. Some credit cards have what are called variable APRs, where it's like, okay, maybe you pay 14%, but then if you have a late payment, it jumps up to 20%. So again, you always got to read the fine print, understand that. Be aware of any fees. So there are credit cards out there that will oftentimes charge you, yearly fees just to have that credit card, or will have cancellation fees, or if you spend less than a certain amount on the credit card, you have to pay a fee. So you always want to be thorough and kind of reviewing any potential fees. And then finally, big recommendation here is you'll see on a credit card bill, it'll say the amount that you owe, but then it'll also say minimum payment required. So maybe the amount you owe is $100, but it'll say minimum payment, you only need to pay $20. Well, if you pay $20 and you send it in and you've paid it on time, okay, it's not going to hurt your credit score. But what that is going to do is that means that remaining $80 you're going to pay interest on next month. So generally speaking, you want to always pay way more than the minimum payment required to save yourself money on interest payments. And there's some great resources out there on the web. There's a lot of credit card payment calculator tools out there. So for example, to show you one real quick, this is one through bankrate.com. So let's say I'm somebody that has, $4,000 on a credit card balance. I've gone crazy. I've spent a lot of money. And let's say that my APR is a fairly high APR. Let's say it's maybe 21%. And by the way, the cards out there that have the highest APRs are the ones, like through a department store. Like you oftentimes go to like Target and they might say, hey, do you want to save 20% today if you sign up for our Target credit card? Well, the reason why they're giving you that deal is that they're going to charge you a super high interest rate then on any, charges amassed. So let's say I racked up $4,000 on my Target credit card at 21%. And let's say though that, it says, oh, my minimum payment is I only have to pay $100 per month. Calculate here. Well, if I would do that, if I would just pay those minimum payments, $100 on my $4,000, it would take me 70 months to pay that off, and I would end up paying almost $3,000 of just interest on that $4,000 loan. So always avoid paying that off. If you ever manage by accident to, amass a large credit card balance, using a tool like one of these payoff calculators can really help you kind of get your mind wrapped around what you need to do. And then finally, the other really good website is if you're somebody that's looking to open a credit card for the first time, there's a website out there. It's called creditcards.com. And it's neat because it lets you look at different credit cards based on credit score. There's ones that, have points. There's ones that are lower interest credit cards. So it just goes to show you that there are lots of options out there in terms of kind of establishing your credit. Okay, so that kind of wraps up the basic overview of what you need to know about credit. From here, we're going to be looking at probably, again, the most important line of credit that you are ever going to establish, and that is mortgages. So we're going to get into that topic next.